In this video, we are going to be discussing the capital asset pricing model. So in short, it's often known as the CAPM model. So what the capital asset pricing model does is that it helps us estimate the required rate of return on a stock. Often in the problems that we see, whether it's in a dividend discount model or in some of the more advanced models, is that the required rate of return on the stock is given to us. But what is the theory behind that required rate of return? Is there a way to estimate how much the return on a stock should be? So based on the capital asset pricing model, the return on the stock is based on two important components. One is the rate of the risk-free return. So the risk-free return, you can think of this as a treasury security. So a treasury security is it's almost guaranteed that you're going to receive your payments, or the federal government is not going to default on its loan. So if you are lending money, you are going to receive it back. So what is the rate of return on a risk-free asset as that, right? It's not technically risk-free, but at the very minimum, what's the opportunity cost of your lowest risk? I think that's the best way to put it. So if a treasury security is paying you 2%, then why should you hold a risky stock that is not paying you the same amount? If it's not paying you the same amount, but you are taking that additional risk, then maybe it's not worth that. Right? So at the very minimum, the stock should pay you, a risky stock or a risky asset should pay you the risk-free return. In addition to that, it should also pay you for with the systematic risk in it. So if you are taking additional risk, right, you're taking additional risk, it should compensate you for that. Now, how do we measure that risk? So for a capital asset pricing model, it assumes that you have a diversified portfolio, which means that if there is just something in particular that's happening with your stock, with one particular stock, that it's not going to impact your entire portfolio because you have other stocks that are compensating for it. Right? So if something in particular happens to your stock, it's idiosyncratic. That means it just happened to that particular company, but it did not affect any other company. Then any loss that you incur for that is going to be compensated by some gains that you have from other companies. So that means you have a portfolio that is well diversified, right? So you're not reliant on just one particular stock's return. So if you have a well diversified stock, then you're not necessarily exposed to just what is happening to that particular company. You can sort of hedge that risk, or I'm missing a word for that, but you're not completely exposed to just that, right? There are other stocks that are going to sort of make up for that loss. But if something happens to the overall stock market, that impacts almost all the stocks in your portfolio. Right? So if the market falls, usually we tend to see that most stocks prices would also fall with the market. So if that is happening, then that is impacting you across almost all your stocks. Right? So that's a risk that we should be concerned about. So that's the theory behind the capital asset pricing model. So it's not about just the idiosyncratic or the company specific risk of this particular stock, but its exposure to the overall stock market. So if the stock market, let's use RM for that. If the stock market return goes up, if the price goes up and the return goes up, then it's likely that your stock's return would also go up too. If the market falls, your stock price would probably fall too. Like your stock's return would probably also fall too. But not all stocks move in the same way. Some are more correlated with the market. So if the market moves, your stock will move too. And it could be even more volatile than the market. So if the market moves a little, the stock reacts more. So the market goes up by 1%, but your stock goes up by 4%. And then if the market falls by 1%, your stock also falls by 4%. So it's more reactive than the market. So if the market changes a little bit, the stock reacts more than that. But then you can have other stocks that are not as reactive. So there is more stability in the prices in relation to how the market is moving. So if, say, the market moves by 1%, we might notice that the stock's return did not move by 1%, but rather it moved by 0.5%. So it's less volatile than the market. It still moves with the market, but the rate at which it's moving, that's much smaller. So not all stocks move at the same rate. So to understand that, we have a measure called beta, and beta will measure the sensitivity of your stock's return with the market stock return. Right? So if it's more sensitive to the market, so market goes up by a little bit, stock returns go up by a lot, then this beta would take a higher value. Whereas if it's less reactive, then this beta will take a smaller value. So those are the main two components. So it should compensate you for at the minimum, the risk-free rate. And in addition to that, it should compensate you for the riskiness or the volatility based on the market movement. And this market return, we're not just concerned about how much the market is making, but how much is the market making in excess, again, of the risk-free return. It's the same idea. If your market is also if you are investing in an S&P 500 ETF, you're still taking on risk. So it's not just the return that you're receiving on the market, it's the return that you're receiving in excess of the risk-free return. Right? And that's it. And that's your capital asset pricing model. This term over here, this is called the market equity premium. Equity premium, right? So market equity premium is this whole term. So RM, so market return minus the risk-free, that is your market risk premium. Okay? So that's the capital asset pricing model. That is one way to estimate what the stock's return should be. Again, remember that it is assuming that you are holding a well-diversified portfolio, so you're not exposed to the idiosyncratic risk of just that company, right? But rather what's important is the total market movement. So here's an example of how it is used. So you have a risk-free return of 3%, the market return is 8%, and the beta for the firm is 1.2. If this is the case, then you can use that to calculate the return for the stock, the required rate of return for the stock. So it will be 3% for the risk-free, 8% minus 3%. So your equity premium over here is 5%. That's the market equity premium, times the beta of 1.2 gives us a required rate of return of 9%. Okay. Few notes about the beta. If the beta is greater than equal to, so if beta is greater than 1, this means that your stock's returns are more volatile than the market. Right? So if market return goes up by 1%, your stock's return will go up by more than 1%. And the same thing goes when it falls. If this falls by 1%, the stock's return would fall by greater than 1%. On the other hand, if your beta is less than 1, that means it is less volatile than the market. So if it's the other way around, so if your market return goes up by 1%, the stock's return would go up by less than 1%. Right? If you have a negative beta, that means it's moving in the opposite direction. So that's it. That's your capital asset pricing model. And you can use the capital asset pricing model to estimate what the return for a stock should be for a well-diversified portfolio.